Well, the stock market was rocked today, and a lot of times we don't know exactly what moves the market one direction or another, but today it was obviously clear. We were up nicely in the morning, but then Donald Trump got a hold of his Twitter account and everything changed. A tweet was sent out suggesting that an additional 10% tariff was going to be tacked on to $300 billion worth of Chinese goods as soon as September 1st, and the market viewed that negatively as an escalation in the trade war, and stocks tumbled immediately after that. Of course, this is after stocks were already a little bit nervous after Jay Powell's comments from the Federal Reserve yesterday. So a lot of markets in an upheaval today. We saw oil get crushed. It was down 7%. We saw bonds skyrocket higher. In fact, interest rates are now at new 2019 lows. So a lot of different things going on within the markets. Unfortunately, all of the US equity indices now have a bearish posture after the last 2 days. And we're going to take a look at a trade application example that is a bearish trade from one of those high-flying technology-oriented companies. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 1st, 2019. First of all, if you're new, welcome aboard. Make sure you go to YouTube, click on subscribe. While you're over there, check out our description area where you can sign up for our email distribution list. Also, we would encourage you to follow us on Twitter. My handle is @BrandonVanZee, and thank you to everybody who clicks like and retweet on these Market Outlook related posts, letting us know that you appreciate them and want them to continue. Lastly, we do have a presence on Facebook as well. Feel free to join us at the group listed in the logo there in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got a slightly different view here today. I always like to look at this kind of heat map here, or market carpet, however you want to describe that, on a big either up or down day, just to kind of give the audience a general sense of how things went today. It wasn't as if we were red in every single instance. We actually had a number of utility stocks over here on the right-hand side that did reasonably well. You can see Southern Company, as an example, was up over 1%. Dominion was up over 2%. We also saw some consumer staples doing reasonably well. Kellogg's came out with their earnings announcement here today. They were up 9%, and General Mills, of course, followed suit there. So a few places to hide out there. And then we had some of the big drug stocks like Eli Lilly and Bristol Myers up over 1% there as well. But besides those key areas, you do see a lot of red across the board. Some more than others. For instance, Best Buy got caught up in the trade tariff talk. You can see Best Buy was down over 10% here today. We also saw that some oil stocks really got blasted here today. Concho Resources, ticker symbol CXO, was down 22% here today as oil tumbled here along with the rest of the market. I did notice that Occidental, which is a trade that we placed here in these presentations maybe a week or two ago, actually bucked the trend. Occidental was up 3.5% today, so maybe a little bit of a place to hide out there within the oil area, but largely we do have a very red screen here in front of us. There weren't a whole lot of places to be hiding out after the bloodbath that took place after that tweet was sent. So with that context in mind, let's now come on over here to the charts to kind of get a sense of where we stand now after the smoke has cleared from a posture perspective. So as a reminder, when we're looking at chart 4B here, and remember, all of you that are premium members of Market Scholars are welcome to follow along with me. In fact, I should also mention, since I didn't get a chance to tell everybody this already, in the chart setups area, I did update charts 2A, 2B, 2C, 3C, and then charts 4S and 4T yesterday. So for those of you that are premium members of Market Scholars with our 3-year subscription, feel free to go check out our tutorial where I show you how to import those links. Anyway, when we're looking here at chart 4B, this is just a foregrid where we can look at the 4 major U.S. equity indices all at once. So that way we can see if they all kind of look the same or whether there's some distinctions between them. Right now, because of the extreme move that we experienced in the last 2 days, you can see that we actually have bearish postures across the board. And that is a fairly significant change. Remember, from going to a bullish posture on the S&P 500 back here on June 6th, we retained that bullish posture all the way up until today. Today, we now flipped it back from bullish to bearish, as the green line on the market forecast technical indicator has now slipped below the upper reversal zone. Remember, on the market forecast technical indicator that you can find over at TD Ameritrade's resources, its upper reversal zone is at 80. So right now, you can see the reading on the green intermediate line is 76.13 and falling, and therefore that is now considered bearish. Now, it isn't considered strongly bearish, and that is the distinction between the dark pink shading like we see over here versus the light pink shading that we see right now. So we don't have a strongly bearish posture, but it is a weakly bearish posture, and that is different from where we were on the S&P 500 going all the way back to the beginning of June. So that's quite the big hiccup, and that will happen when you have two very sizable candles the way that we did the last couple of days, especially also notating that we're now trading below that rising 30-day moving average there. So pretty ugly back-to-back sessions that we've lived through here the last couple of days. Doesn't get much better over here on the Dow Jones. You can see the Dow Jones was down even more than the S&P 500 today. The Dow Jones was down over 1%. Remember, a lot of big industrials companies like Boeing are part of the Dow Jones Industrial Average. They might get caught up in those trade wars a bit more than some smaller companies out there. And so the Dow, which actually went to a weekly bearish posture yesterday, continued that downward trend here today. Similar with the Russell 2000 down below, it gave us a bearish posture as of yesterday. It continued lower as of today. And then the NASDAQ composite was a little bit closer to the S&P 500, where it wasn't willing to give us the bearish posture yesterday, but after two back-to-back days like this, it's now willing to do that. So again, the big news story from kind of the posture setting perspective using that market forecast technical indicator is that we do have bearish postures across the board right now. So it might be time for us to kind of hunker down, maybe in some of those more defensive areas like your utilities or staples or some of those other areas that I mentioned here a moment ago. But you know, the more speculative areas like your technology-oriented companies or some of the cyclicals like your industrials might be struggling a bit more unless we get some sort of a resolution on the trade front here. Let's go ahead and take a look at our next chart setup now. And this will be chart 4C. This is our 3 green arrows chart setup, but in today's case, we should rename it the 3 red arrows setup because all 4 of our charts now have 3 red arrows. And for those of you that are not familiar with that particular concept, it's just basically looking at 3 different technical indicators: the 30-day moving average, the MACD histogram, and the stochastics, and then looking to see if they have either green or red arrows, with red arrows being negative and green arrows being positive. So right now, you can see the background colors of all 4 of our charts are pink as of today because we have 3 red arrows across the board. You can see that all of our charts show a candle that closed below the moving average. In fact, the Dow had already done that yesterday, so that red arrow came in right there. But on the other 3 charts, that was the culprit. We got our third of the 3 red arrows today because the NASDAQ, the S&P 500, and the Russell 2000 all had a significant enough candle lower that it closed below the 30-day moving average. And remember, that's a pretty big deal. It hasn't occurred since going all the way back to late May and early June in most cases. You can see right back over here, we got a green arrow as the S&P 500 closed above the moving average back here on June 7th. And that has been the case all the way up until today. So that was a decent 2-month run or thereabouts to the upside. But now it might be time for the bears to take control and run with the ball a little bit more. Of course, we are now in the month of August. Tomorrow actually is going to be a Jobs Friday. Remember, the first Friday of the month is typically a Jobs Friday. So we're going to have to look out for additional potential volatility as a result of that. Also, I should remind you, remember, David is on vacation right now, and so there will be no market outlook video tomorrow or on Monday. I'll be back with you on Tuesday, but there won't be one tomorrow, so don't plan on seeing that in your inbox or anything along those lines. Remember, David was actually on vacation yesterday as well, but he was nice enough to do a special post-FOMC presentation last night that y'all are welcome to watch if you want. He did record it, so let me explain that here briefly. If you come on over here to the Market Scholars website and you click on the Trading Rooms menu item up at the top of our website, you'll then see our new events for the month of August. So last night, of course, was still July, but you can kind of see it grayed out right here where it says Market Outlook Webinar. You could click on it right here if you wanted to. You could also click on this little widget on the left-hand side there that will scroll you back to the month of July on our calendar. And then, of course, you'd scroll down here to the 31st where you can watch it right there. Now, remember, you do have to have a username on our website to do that, but it can be just one of those basic free usernames. So if you don't have a username on our website yet, you can come up here to where it says subscribe and click on that and sign up. You just got to put your email address in there for that. Sometimes you'll see that banner up at the top of our website that says click to subscribe there as well. So that is available not only to those of you that are premium or plus members of Market Scholars, but also the basic free accounts are eligible to watch that particular special recording where you can get David Settle's insights as to what to expect going forward now that we know that the market or that the FOMC has cut interest rates by a quarter point there. You know, after today's tweet from President Trump, you know, the market is probably expecting further cuts down the road, and that is shining through most definitely on the charts of bonds and interest rates that we will look at here in just a little bit. Before we get to that, real quick, since I'm on the internet already, also let me point out the fact that we do have a pricing table that's available on our website now. We've gotten a lot of feedback from many of you over the last year plus since we've been in business that you'd like a slightly slimmer package of educational offerings at a lower price point than what other folks had paid in the past for the premium. Certainly understandable. So we did kind of break it out into a couple different levels. You can find this now by coming over to our website and clicking on the services tab that you'll see here just to the left of Trading Rooms. But down below you'll see that basic one that I mentioned before. That is your free one, but we do now have a plus which is kind of that mid-size model in addition to the premium model that most of you have already signed up with in the past. Now, one thing to quickly note here as you're looking through this, the Thinkorswim chart scripts that many of you ask us about, there's 34 of them that we have now that are customized that we built out over time. Those are only available on the yearly premium subscription. So we want to make sure that we're crystal clear on that so there's no confusion. So you would have to click on the yearly up here and then sign up for the premium. But that is definitely the best value because we give you the most offerings there, and as long as you're willing to pay a bigger chunk up front, it's actually a cheaper cost to you on a monthly basis if you want to think about it in those terms. So anyway, it's been a long time coming, but we finally have a pricing table on our website for those of you that have asked us about that over time, and we do appreciate your patience as we were able to finally get that up and running there. All right, let's get back on track with some of the chart patterns now. I'm going to take a look at kind of a weekly chart to see if that adjusted anything from our expectations there. Let's go to chart 4D over here on the Thinkorswim platform. And this will be our longer term view. Remember, this is our 1040 crossover method chart, and it does lag, you know, and that is one thing that you have to consider when you're using technical analysis. You know, there's not a bell that gets rung at the top, and there's, you know, not a bell at the bottom. So a lot of times when you're using technical analysis, you are using indicators that are taking past information to give you information about the future. Now, in this particular case, when you're using a 10-week moving average, you know, that is, you know, 50 total days that's involved in a 10-week moving average right there. So 50 trading days, I should be clear on that. And then on the 40-week moving average, that's 200 days. So of course, you're not going to get in and out at the exact top and the exact bottom with this, but it does give you a pretty good general sense as to where the trends from a longer term perspective are. So I guess if there was one little glimmer of hope after the last couple of days of selling is from a longer term perspective, there still is not a bearish posture. We still continue to have a bullish 1040 crossover method posture at this particular time. Now, the one that is the most threatening to lose that bullishness is the Russell 2000, which is our chart in the lower right-hand corner here. Now, remember, it's only Thursday, so we don't know what tomorrow will bring, and with this being a weekly candle chart, it's not going to be set in stone until tomorrow. But nonetheless, as of this exact moment in time, we do not have the moving averages themselves crossing over, so we do not have a death cross yet. However, we do have a red arrow above the candle here this week. And what that represents is just a kind of initial heads up that price is now trading below the 10-week moving average. So the 10-week moving average has not crossed below the 40 moving average, and that's why the background color is still green. But, for that to eventually happen, if it is to occur, then of course price has to eventually start trading down below the 10 period, and that's where we're at right now. So it's not a serious thing quite yet, because it's not like we have massive broken down support levels or anything like that. But obviously the last 2 days have been quite ugly, and therefore it wouldn't be entirely unexpected if this was the start of a little bit of a rockier period. Remember, going into the fall is oftentimes a bit more volatile for the stock market. September and October in particular are known as months where market crashes can occur. But even August, some of you will remember back to August of 2011 when the USA lost its AAA credit rating. And we had tons of market turbulence back then as well. So August, September, October, they can be areas where traders start to get a little bit more squeamish. And so we just have to stay ever vigilant, especially with our more active types of trading portfolios. All right, let's go ahead and now take a look at our next chart setup, and this is going to be chart 4E. This is our intermarket analysis chart. And this is where we saw a lot of activity here today. So a few things to share. Now, before we get started, remember that when we're looking at these 12 grids, the background colors are going to change either pink or green. If they're pink, that means that it has a bearish posture using the intermediate term line on the market forecast technical indicator. If the background color is green, it means it has a bullish intermediate term posture using that same green line on the market forecast. So let's get into it. The VIX soared today. Not a surprise there. It was up big yesterday. In fact, it's been up pretty nicely 4 straight days. So we're now sitting at about 18 on the VIX. Now that's not considered extraordinarily high. Remember back in the crisis of 08-09, it got up to 90. So 18 is a far cry from 90. But nonetheless, this is the highest level that the VIX has touched since going back to late May. And of course that makes sense. I mentioned before that we got the bullish posture in the market in late May, early June, and the VIX typically moves inversely to the stock market itself. So now that we've lost that bullish posture on the stock market, the VIX is perking up here, showing that there's a bit more fear in the system. And we just don't know where this China trade war is going to take us, whether it's going to end up benefiting corporations and their profitability or not. Most economists would say that free trade is a good thing for profits, but others would argue that having better jobs in the country and having more of a protectionist view may be the better path. In the end, the stock market will let us know soon enough, but right now it does seem like there's a bit more squeamishness out there, and again, that is kind of manifesting itself through the VIX itself right there. So remember, from an options trading perspective, depending upon your mindset, that might be a good thing. For those of you that have been kind of waiting for higher VIX levels in order to get more enticing premiums when you're selling credit spreads and selling puts and selling cover calls and different things like with that, where you're a seller of options contracts, having a higher VIX level may actually benefit your trade in the end if you expect that VIX to kind of peter out there after a little bit of a shot in the arm. Another thing that's worth mentioning, this is a biggie. Take a look at the treasury yields. These things just completely fell out of bed today. It was real interesting too, because it almost looked like treasury yields were trying their best to stabilize over the last month. In fact, we had seen a certain type of a sector rotation where utilities and REITs started to struggle on a relative basis that made it seem like that move in the treasury yields was a bit more legitimate. Well, today threw all that out the window. As you can see, TNX fell 6% today. I mean, you don't need to know a whole lot about intermarket analysis. All you need to do is look at the size of that candle right there. It's clearly, and let me right click and maximize that chart so you can look at it a little bit bigger. That's clearly the most dominant candle on this entire board for the last 3 months there. That is not a normal sized candle right there. With Treasury, 10-year Treasury yields now below 1.9. Remember, on the Thinkorswim platform, just move that decimal point over to the left one when you're pulling up TNX, and that will tell you what the current 10-year rate is. And so it's at 1.89% right now. Quite an extraordinary turn of events right there. So, of course, the opposite of that is also true. If you look at TLT, the chart directly below it, remember that tracks the long bond, the long U.S. government bond. And that thing just absolutely skyrocketed here today. Again, same thing except for inverse, which is this is most definitely the most emphatic candle on the board. In this case, it's skyrocketing higher, clearing that prior resistance area that we saw from July 3rd right there in the process. So TLT ended the day at 135. Bond market is off and running yet again. And of course, they're not just conditioned to do that in the United States. You can see foreign bonds continued to be a stalwart chart. I've talked about this countless times for the last 3 months as I've been giving these presentations, because I've always been joking that it's not very fun to talk about. Nonetheless, it's worth noting foreign bonds have been one of the best charts on the entire board. I mean, that is the epitome of consistency right there. We had one little fallout right back here on BNDX back in mid-July, but that's about it. For the most part, you throw a dart at this chart and you land it on a day when foreign bonds went up compared to their prior day. So that has been an extremely consistent chart, and today was no exception to that. Money continues to pour into the bond market. As you can see, it did affect the dollar to a degree. Now, the dollar was kind of interesting. UUP is in the lower left-hand corner here. The dollar was actually up significantly early in the morning, but as that tweet came out, it sold off and closed at the lows of the session. Now keep this in mind, the dollar's still up significantly over the last 2 weeks. So, what we gave back today was just part of yesterday's candle. That was it. But it is kind of worth noting that that's a pretty ugly looking candlestick pattern right there. So we want to keep our eye on it because the dollar has had a really strong run here recently, and it might be time for it to kind of cool off a little bit. In fact, you saw that it had a overbought cluster signal here within the last week or so as well. Now you will notice that the ag commodity complex completely fell out of bed here today. Ag commodities were down another 1%, but that's not the full story. The full story is they've sold off for basically the last 6 or 7 sessions in a row and continue to produce these oversold cluster signals. So you just can't get out of your own way if you're in the ag commodity space right now, it seems. And part of that has to deal with the trade war as well. Remember that China had committed to buying soybeans and other crops from U.S. farmers, but it seems like as that trade war kind of gets ratcheted up a bit more, that there is the chance that they will renege a little bit on what they had mentioned before. So that is now pressuring prices of commodities. Of course, if China or the rest of the world came out and said that they wanted to, buy commodities hand over fist, that might start, supporting prices, and we might see that start rising again. But right now, we seem to be heading the opposite direction. So not a great sign there if you're a farmer. You'll also notice that the ag commodities weren't alone. Now remember, the crude oil contracts have already rolled over to the new day. So this percentage that you see right here is not the worst of it. Let me put in USO, which is meant to track oil, and you'll see that it was down 6% here today. This is an exchange traded product. It's not a contract, a futures contract itself. So this number here is a bit more accurate from a percentage basis as to how things performed today. And it was a fallout to a large degree right there in oil prices. And you can see that there if I type in /CL as well. That's your crude oil contract. That's the candle that I'm referring to. That was effectively today's candle. And it just completely collapsed there, down about 7% when it was all said and done. And that's unfortunate because it was just a couple days ago where it looked somewhat promising, like, hey, look, we're starting to get a nice rounded bottom there. We're starting to roll higher. We start to close above that moving average. It actually started to look a bit more promising. And then, boom, last 2 days, Jay Powell day number 1, Donald Trump day number 2, and all of a sudden we're trading at multi-week lows on crude oil right now. So ugly session there for crude oil as well, and that of course bled into the master limited partnerships, which have been falling out of bed here the last few sessions as well. Let's go ahead and now take a look at our next 12 grid, and this will be our foreign stock markets 12 grid. This is chart 4F. All right, so as you can see here, you weren't able to escape the sell-off in most other parts of the world either. The exception of that might have been Israel. Israel was up here today, ticker symbol EIS. That happens to be the only chart that remains green on the board as well. So not only was it up today, but it remains with a bullish intermediate posture according to the market forecast as it continues to trade above that rising moving average. So that seems to be a bastion of safety right now. Most other parts of the world are starting to look quite ugly. In fact, some of them had already been ugly, right? We were already talking about how India was falling out of bed last week, and the United Kingdom down below, and Germany bouncing down off of their moving average. So some of them had already been starting this process even before the last couple of days. But of course, the last couple of days didn't help the matter. Things are just starting to pick up a bit more steam. Now, in some cases, like with Mexico up here, you can see that we did put in an oversold cluster signal. So that occurs, let me right click and maximize this cell. That occurs when we get the 3 market forecast lines, the blue line, the green line, and the red line, all in the lower reversal zone below 20 on the same day. So what that is trying to tell us is that the sell-off has occurred maybe a little bit too far, too fast. Now remember, that can resolve itself in a number of ways. What I tend to think of it as is it telling me that it's not going to continue to go down at the same rapid pace that it has to lead us into this condition. But what that can mean is the stock could go sideways, the stock could continue to go lower, just not at the same rapid pace that it has the last couple of days, or the stock could revert back to the mean to the opposite direction. So we might be due for a little bit of a bounce there in Mexico in one of these upcoming sessions. But a lot of these other charts, look at China. China was down 2.26% today. So if we thought we had it bad here in the United States, it was even worse over in China. And that is one ugly looking candle right there, as well as China is very close to multi-month lows here. We'll see if it can catch a little bit of support in this area where it tried to bounce back here in June. But given the pace that it's gone down there, I don't know if I'd be a betting man when it came to that. Let's go ahead and take a look at our next chart setup. This will be chart 4G, and this is our U.S. sectors 12 grid. So up here in the upper left, you can see that this is the S&P 500, and as I mentioned at the top of the video, we now have a bearish posture, so that's why the background color is pink here. Now the 11 charts that follow it are the 11 sectors that make up the S&P 500. And as I mentioned, there were actually a couple places to hide today, and those places were largely defensive in nature. Utilities actually had a brilliant day. They were up over 1% today. XLRE, which tracks the real estate space, was also up, not nearly as much as the utilities, but nonetheless kind of proven their worth as a interest rate sensitive category, and they were up today as well. They were up 0.24%. You can see both of those charts have a green background telling us that the intermediate term posture for them is bullish at this current time. Now, interestingly enough, technology is also a green background color chart, even though it was down here today. Now, note that that particular chart there, technology, did land exactly on that moving average. Notice that a lot of these other charts are already crossing below it. So like, energy falling out of bed. There's materials and industrials really suffered here today. There's the discretionary stocks. A lot of those retailers that buy their clothes from China to sell in their retail establishments here in the United States, they suffered here today. So a lot of these charts are showing breakdowns below those moving averages. Technology has actually held the line decently well. Now, part of the story there is Apple. Apple did have a nice response to their earnings here within the last couple of days, and Apple is the largest technology company outside of Microsoft. They kind of go neck and neck depending upon the day, but nonetheless, that chart still is hanging on just by the skin of its teeth, so to speak, to a bullish posture. But if we do have another sell-off tomorrow, let's say that the jobs report comes out tomorrow and it disappoints the market, I would anticipate that technology would probably move to a bearish posture at that point, whereas utilities and real estate have a better chance of hanging on to their bullish postures because they are known as defensive areas. So again, this should not be the case that you have an entire sector up 1% on a day when the market was down almost 1%. But because of that interest rate sensitive nature of the utilities, as I mentioned a moment ago, utilities completely skyrocketed because interest rates completely fell out of bed. So when interest rates spiked down to new 2019 lows, that helps the utilities and the real estate stocks on a relative basis. And of course, that's a concept that we talk about quite a bit over in my dividend growth investing classes when we discuss those particular sectors, since they are more of your income producers. Unfortunately, the staples were down today. That is also an area that is oftentimes viewed as more defensive in nature. They were down 0.35% today. They now do have a bearish posture according to the market forecast. But, all things considered, it wasn't a terrible day for them. That was, one of the better performing sectors out there, even though they were down here a bit today. Now, again, part of that would have been due to the fact that Kellogg's had that really nice breakout move on their earnings announcement there. Surprisingly, healthcare did have a positive result for the day. They were up 0.13%. Now, again, that was probably because of Eli Lilly and some of those, big drug stocks that I mentioned before. But I don't think this chart looks quite as good on healthcare. The staples chart actually still looks reasonably strong, whereas notice that the healthcare, it's a little bit different because that moving average is now painted red. So if I were to right click and maximize that cell, note right here, the moving average is now red, signifying that price is below a falling moving average. Whereas if I were to show you the staples chart, we're not seeing that at this exact time quite yet. So I do still think the staples look a little bit better than healthcare here, but without a doubt, on a day like today, if there was any strength in the market, it's going to be on your bottom rung here where we hold those defensive and interest rate sensitive types of sectors. All right, so that brings us to our trade application example here for the day. Let me come on over here to chart 4A. And let me pull up a stock that's in the communications sector. However, a lot of people kind of view it as more of a technology-oriented company, and that is Netflix. Now, as you can see, Netflix sold off with the rest of the market today. Not a big surprise there. Netflix was down over 1% here today. But importantly for our conversation during this video, where we do focus on that market forecast technical indicator, you can see that there was a change that took place today. We now have a bearish posture. So we went from this green background color to this red background color here with today's sell-off in its price. And you can kind of see that we have a bit of a, almost like a bear flag type of a setup that's taking place there as well. This stock, of course, gapped down on its earnings, continued to fall, then rebounded, couldn't advance its cause any further, and now has been kind of giving up the ghost here over the last 4 sessions. And in doing so, that green line went from going up out of that lower reversal zone right there to then petering out at this juncture right here in the last couple of sessions. And so now that we have that bearish posture back on Netflix, I thought it would be a good time to practice a bearish trade. Remember, we got to shake that rust off. Some of you are not nearly as comfortable with bearish trades as you are with bullish trades. So every so often, even if it's only in a paper money environment like we're in here, it makes sense to at least not get caught flat-footed whenever the market does turn tail in the opposite direction. So what we're going to do here today is known as a long put spread, and that is a bearish trade. It is a debit spread, and it is a trade where you want that stock to continue to go lower, not higher. So let's go on over here to the trade tab itself, and you can see I've got the spread loaded up down below here. I am focusing on the September monthly contracts, so these are the ones right here with 50 days until expiration. Let me open that up so you can kind of see that a little bit better there on the strike chain. And the way that we typically will do these long verticals, debit spreads, is look for one strike that's in the money and one strike that's out of the money. Now, right now, Netflix closed today's session at 319.50. 350. And so the at the money strike would be $320, of course. So what I did is I selected the 325 here, which is the first put in the money, and then I also selected the 315, which is the first put out of the money if you assume the 320 is the at the money. So down below you can see I've got that trade loaded up where I've got +1 contract at the 325 put, so that is by itself. Remember, when you're buying a put, that's a bearish stance. But in addition to having that long put, I've also sold a put. Now, for those of you that are familiar with that concept, all by itself, selling a put is actually a bullish thing. So you're taking one bearish thing, combining it with one bullish thing, and the net effect is that you've got a slightly more bearish trade than you would have otherwise. And the reason for that is because the value that you're paying for the contract here on the 325 is worth more than what you are selling at the 315. So the net effect of those two things is you are paying money out of your pocket. You can see right here that the debit is right around $5. So in other words, this is a $10 wide spread here. What we are hoping to accomplish is to have Netflix close below $315 50 days from right now. We have to pay $4 for the right to purchase this $10 wide spread, or it's actually $4.99, closer to $5. So if you want to just round up one more penny there, we'll say it's $5. So in other words, you could subtract the $5 out of the 325. That leaves you with 320, effectively where we're trading right now. And so you have opportunity to make $5 by spending $5. In other words, this would be a 100% return on your risk possibility. Now, that's the stressing word there is possibility. Of course, there's no guarantees. But if Netflix were to continue to fall for the next 50 days, and remember, there's a lot of competition coming out, whether it's Disney Plus or some of these other, bundled packages out there that now Netflix all of a sudden has competition with, then this would be a trade where you could, exercise your thought that Netflix is going to be in trouble and try to make some money within the options market in doing so. So if I were to click confirm and send, you can kind of see some of the metrics there. My max profit in this case is $501. My max loss is $499. So anyway, it's a one-for-one type of a trade. You're going to risk $500, but you have the possibility of making $500 in pure profit as well. So that's where your 100% return on risk possibility comes from. So I'll go ahead and send that one off. We'll see if we can get filled first thing in the morning. And remember, again, what we're hoping to accomplish here is for Netflix to close kind of below where my cursor is right there on the chart. You're not asking a lot out of it. We just need it to continue to meander lower for the next 50 days for us to win this particular trade. All right, well, thank you so much for joining me here tonight. Remember, David's not going to be here tomorrow. He's on vacation, so there is no Market Outlook video. I'll be back with you next Tuesday, not Monday, but Tuesday, when I normally do these sessions. And so you guys have a great weekend there. Remember, if you get value out of these videos, it really helps us along if you click like and retweet over on Twitter. So thank you to those of you that do that. But remember, the takeaway from tonight's session is we now have bearish postures across the board. So get out there and get your paper money accounts open and start practicing some of those bearish trades again if you need to shake that rust off. And of course, tomorrow is a big day as well, as we have that jobs announcement, and that could have the possibility of more volatility for traders. So we'll stay vigilant, but you guys have a great weekend. Best of success with your trades and your investments. Goodbye for now.